So you wanna go to war with me? You're talking like you think you're royalty. You think that I'm afraid, but I don't break. I heard you question my stability. You think I'll fall just like a guillotine, but I'm here to stay. Look away. Storm is coming, so you better start running. We can't control it. Our bones out, could flip. I'm coming for the throne. Coming for the throne. So you wanna be my enemy? You should've known I'd never kiss the rain. Ice runs in my veins. Won't play it safe. I don't belong with your nobility. Who died and made you king of London? You think that I'm insane? It's your mistake. Kingdoms rise and fall. I come to take it all. I'll take it. I've come to take it. Kingdoms rise and fall. I've come to take it all. I'll take it all. Storm's coming, so you better start running. We can't control it. Our bones out, could flip. I'm coming for the throne. I'm coming for the throne.
Let's go. Yeah. I'm like an addict, do I gotta have it. I ain't even playing, got a really bad habit. If it moves, gotta grab it. Fuse like a magnet, lose, won't have it till I'm doomed in a casket. I ain't playing, got a weird mind. If you work 8 hours, I'ma work 9. If the shit tastes sour, you should taste mine. I'ma stay in power for a long time. Get up, nah, I ain't a quitter. Toss me the ball, I'm a really big hitter. Big picture, I'm a straight killer. I send a song to the highest bidder. Got juice, got gas, I'ma move fast. New shoes, new tracks, like who's that? I'm new, come back, better than last. Yeah, it's a new me, never gonna look back. Never gonna look back. Cause damn, I'm still the last. You move slow and I move fast. And that's facts. Only I can make a change. Slowly take a step today. I will never be the same. Cause that's
All right, y'all, good morning. Happy Halloween. October 31st, we have the Marcus Corp Q3 earnings coming up in just about 10 minutes. Ticker is MCS. This is a regional cinema company up in the northeastern U.S. They also own hotels, which makes them a little bit interesting in terms of trying to figure out the analysis. It's not just a straight box office play. We traded this company very profitably in 2024. Let me pull up an easier chart to read here. Here we go. We had identified a price target back in early 2024 on the dip in the industry, and this stock got as low as $9 and change. Ended up buying it at $11.55 in June of 2024, selling up here at $22.13 in November, which in retrospect, it kind of goes with my whole AMC thesis and everything. 2025 was just going to be a little bit rough for everybody up until about this point. Thanksgiving and beyond, I think, will be better. October is looking horrible, but I think it gets better starting around Thanksgiving into 2026, 2027. And we want to load up on profitable cinema companies. If you like trading in this segment, you want to load up when things are looking pretty bad. And so I sold at 22 in November, and I just rebought this morning. We have a demand zone here for the ticker between 12.79 and 13.25-ish. I didn't quite get the bottom. Unless there's a collapse, if there's a further collapse, which I'm not anticipating, I would increase my buys. But my entry price here on this next swing, which I'm probably will be holding for a year, is $13.95. I've got a $24 price target. That's a 71% increase in a profitable cinema chain. In my book, someone asked in the chat, is this a good trade? 71% in 12 months. If you're bullish on the box office, what's not to like about that? Is it going to give you 1,000% tomorrow like we had in Beyond Meat last week? No, that's a different type of swing trade with much higher risk. This company has a lot of earnings and stability and things we can go look at. And I think we're at the worst part of this year right about now. And you can see that from the chart too. Worst in terms of, just the sentiment in the box office is horrible right now with this paltry October that we have. It is what it is, but that's why paying attention to this stuff really matters, because if you're wanting to pounce on whichever company, AMC, Cinemark, IMAX, Marcus Corp, you need to be paying attention to the box office, not just how bad is it right now, but what's coming also. And then you analyze the companies. Are they doing good? Are they losing money? If they're losing money, what corporate actions are coming up? And what corporate actions are coming up with MCS? They're buying shares back. They've bought back 9 million this quarter, 16 million so far for the year. Companies buy back when they have free cash and they think that their stock is undervalued relative to where it's going to be in the next year. That is delivering shareholder value with available cash. And you have the luxury of doing that when you have excess cash. I know a lot of people, when's the AMC going to do share buyback? They don't have available cash. They're like scrambling with any cash to fix their balance sheet and stay afloat. So no, I'm not expecting any share buybacks on AMC. As much as we'd like to see that, it would be a poor use of cash right now. But we see certain companies like Cinemark and MCS, and I think IMAX even all able to do share buybacks. AMC will probably get there one day, but not anytime soon. In the meantime, if we like this sector, if we're closely following it every day, why not have a little bit of money riding on the companies that are standing to significantly benefit and have relative safety for the sector? 4 minutes to go for the Q3 earnings call. Anya, good morning. Tom, good morning. He says bought 300 shares at $13.80. Let's go. I feel pretty confident about this one, Tom. unless, you know, and I felt confident buying it a year and a half ago too, and we doubled our money back then. I think we will double our money again, unless the entire market crashes or there's another COVID. But hey, look, if the entire market crashes, it doesn't matter what tickers you're holding. Everything's going to get obliterated. So I won't blame GameStop if it goes down. I won't blame Marcus Corp if it goes down. If the market craters, well, our only salvation is to completely exit before we bleed dry, or hold through it and buy the dips. Buy the dips. Let's see. Speaking of the market, Bitcoin at 110. So we had a little bit of a dip down to 103, 106, 107, but it's on the way back up. Gold and silver this morning are looking what? Slightly in the red. Slightly in the red on our, these are our junior mining baskets on the top. I don't own GDXJ or SILJ, but if you're looking to spread your risk around on gold or silver juniors, companies that are in exploratory phase, those are two tickers to look at, GDXJ, SILJ. If you want to just bet on gold or silver, you could buy physical, or you could buy GLD or SLV, which I do own SLV. It's in the bottom left here. And I have one speculative bet on a junior miner HYMC, which is in the bottom right. But if you're betting junior miners, make sure you know what you're doing. This is speculative territory, friends. Anya says, what percentage of their money is in hotels versus movie theaters? I have covered that in previous earnings summary, Anya, and I don't remember top of brain recall. I'm sure it'll be covered in today's slide deck, or we'll pull it up as they're talking. I don't remember off the top of my head. I know I've covered it before. There's only so many random facts I can stuff away for instant recall. They'll go over it. Alexander, good afternoon. AMC Hawkeye says 62% ownership. MCS does not lease their theaters. Thank you for that. I should have prepared better and refreshed my memory cells. Reload MCS to the top of the stack. Those of you who are familiar with assembly language and processors, you know what I'm talking about here. But yeah, I have it somewhere stored in ROM. It's not in RAM. 1 minute to go. I'm waiting here for the music to be over, and then we'll put this call up where you guys can hear it. Can you believe way back in the day, little old me, they used to fly me out to California to take assembly language classes from Intel. How to understand the boot up sequence on a 8088 processor. Oh boy. That was my previous life, guys. High tech. 15 years. Degree in economics, minors in finance and banking, yet somehow I got in high tech and engineering. Right place, right time. Yeah, I need it in local cash, right, Dink? Yeah. Let's see if we still got music here. Yep, still got music. All right, momentarily we'll be starting. Yeah, I used to do all that nerdy stuff, Dink. Logic analyzers, oscilloscopes. Somehow got out of that and moved into product development, and then supplier management, which allowed me to travel all around the world. It was a frickin' blast. Still got music. Still got music. Come on, you guys up there. Alexander says boot up process. I remember when that was difficult for a lot of people. Imagine trying to troubleshoot a circuit board, Alexander, where you plug it in and literally nothing happens. That was my job for about a year. All right, now fix this. Well, nothing's happening. All right, well, throw the logic analyzer on it and step through the boot up sequence, one assembly line at a time, and figure out where it's getting hung up. We had one guy, one technician in our group, he had no idea how to use a logic analyzer or read assembly. So he'd send the board over to the soldering techs and have them replace every major chip on the board. That guy eventually got fired. That's not an efficient way to work. Dink says, I have written in 8086. You must be old like me, Dink.
Corporation.
All right, here we go, ladies and gentlemen.
My name's Lydia, and I'll be your operator today. At this time, all participants are in listen-only mode. We'll conduct a question and answer session towards the end of this conference. If at any time during the call you require assistance, please press *0 and an operator.
I can't remember if they'll have a presentation on this screen or not. If they don't, I'll pull it up on a bigger screen.
Are Greg Marcus, Chairman, President, and Chief Executive Officer, and Chad Paris, Chief Financial Officer and Treasurer of Marcus Corporation. At this time, I'd like to turn the program over to Mr. Paris for his opening remarks. Please go ahead, sir.
Good morning, and welcome to our fiscal 2025 third quarter conference call. I need to begin by stating that we plan to make a number of forward-looking statements on our call today, which may be identified by our use of words such as believe, anticipate, expect, or other similar words. Our forward-looking statements are subject to certain risks and uncertainties which may cause our actual results to differ materially from those expected or projected in our forward-looking statements. These statements are only made as of the date of this conference call, and we disclaim any obligation to publicly update such forward-looking statements to reflect subsequent events or circumstances. The risks and uncertainties which could impact our ability to achieve our expectations identified in our forward-looking statements are included under the heading Forward-Looking Statements in the press release we issued this morning announcing our third quarter results, and in the Risk Factors section of our fiscal 2024 annual report on Form 10-K, which you can access on the SEC's website. Additionally, we refer you to the disclosures and reconciliations we provided in today's earnings press release regarding the use of adjusted EBITDA, a non-GAAP financial measure, in evaluating our performance and its limitations, a copy of which is available on the Investor Relations page of our website at investors.marcuscorp.com. All right, with that behind us, let's begin. I'll start this morning by spending a few minutes sharing the results from our third quarter, and then discuss our balance sheet, liquidity, and capital allocation. I'll then turn the call over to Greg, who will focus his prepared remarks on where our businesses are today and what we are seeing ahead. We'll then open up the call for questions. This morning, we reported a quarter with solid results overall, despite somewhat mixed results in our divisions relative to our expectations. During our seasonally busiest quarter, our teams in both businesses remain focused on serving our guests with excellence to deliver memorable experiences. I'll start with a few highlights from our consolidated results for the third quarter of 2025. Consolidated revenues of $210 million were down 9.7% compared to the prior year quarter. Operating income for the quarter was $22.7 million, a decrease of $10.1 million compared to the prior year quarter. Consolidated adjusted EBITDA for the third quarter was $40.4 million, a decrease of $11.9 million compared to the third quarter of fiscal 2024. Net earnings for the quarter were $16.2 million, or 52 cents per share, and were favorably impacted by a non-recurring gain on a property insurance settlement of $3 million, or 10 cents per share net of tax. Excluding the impact of the gain, net earnings for the third quarter were $13.2 million, or 42 cents per share, compared to prior year third quarter net earnings of $24.8 million, or 78 cents per share, excluding the impacts of our convertible debt repurchases last year. The change in our fiscal year and quarters had an immaterial impact on our third quarter results, with one additional operating day during the quarter in fiscal 2025 compared to last year. Turning to our segment results, I'll begin this morning with our theater division. Third quarter fiscal 2025 total revenue of $119.9 million decreased approximately 16% compared to the prior year third quarter, primarily due to weaker performances from the top films in the quarter compared to the top films in the quarter last year, and less carryover of films that released in the second quarter compared to last year's carryover. Comparable theater admission revenue for the third quarter decreased 15.8%, and comparable theater attendance decreased 18.7% compared with our fiscal third quarter 2024. While our market share in the third quarter of 2025 was in line with our historical third quarter share, including our third quarter share in 2023, this year's film mix did not help us. Notably, the film slate did not include a family animated film in the top 5 movies of the quarter, a genre that our circuit typically outperforms in. When using our comparable fiscal days, U.S. box office receipts decreased 12% during our fiscal 2025 third quarter compared to U.S. box office receipts during our fiscal third quarter last year, indicating our admissions revenue performance trailed the industry by 3.8 percentage points. We believe that our lower box office performance relative to the nation during the third quarter was primarily attributable to our strong performance in the third quarter last year, when our circuit outperformed the national box office growth by nearly 6 percentage points. As you may recall, a year ago, our third quarter 2024 box office results benefited from a favorable film mix in which we achieved above our historical average market share for each of our top 6 movies in the quarter, including several films such as Inside Out 2, Despicable Me 4, and Twisters, where we significantly outperformed our typical share. Our admissions revenues did benefit from several pricing changes that we discussed with you last quarter, with average admission price increasing 3.6% during the third quarter of fiscal 2025 compared to last year. Our admission per caps were favorably impacted by strategic pricing changes, including adjustments to our everyday matinee program and pricing surcharges on select high-demand summer blockbuster films. In addition, admission per caps were also favorably impacted by a higher percentage of our attendance on PLF screens compared to last year's quarter. We also grew our average concession, food, and beverage revenues per person at our comparable theaters, which increased by 2.1% during the third quarter of fiscal 2025 compared to last year's third quarter, and was driven by an increase in merchandise sales and pricing. Our top 10 films in the quarter represented approximately 72% of the box office in the third quarter of fiscal 2025, compared to 83% for the top 10 films in the third quarter last year. The less concentrated film slate, featuring fewer blockbuster films compared to the more concentrated slate in the third quarter last year, resulted in an approximately 3 percentage point decrease in overall film cost as a percentage of admission revenues. Finally, theater division adjusted EBITDA during the third quarter of fiscal 2025 was $22.1 million, a 33% decrease over the prior year quarter, primarily due to the lower attendance volumes. Turning to our hotels and resorts division, total revenues before cost reimbursements were $80.3 million for the third quarter of fiscal 2025, a 1.7% increase compared to the prior year. RevPAR for our comparable owned hotels decreased 1.5% during the third quarter compared to the prior year, which resulted from an overall occupancy rate increase of 1.7 percentage points, offset by a 3.6% decrease in our average daily rate, or ADR. Our average occupancy rate for our owned hotels was 78.4% during the third quarter of 2025. As you may recall, our third quarter 2024 results benefited from the Republican National Convention and its significant impact on the results at our 3 Milwaukee hotels, resulting in approximately $3.3 million of incremental revenue. The RNC primarily had the effect of increasing average daily rates, and when we adjust out that one-time impact, we achieved some very impressive rate and RevPAR growth. When excluding the impact of the RNC on our 3 Milwaukee hotels from last year's results, our average daily rate during the third quarter of 2025 grew approximately 5% compared to the prior year quarter, and RevPAR grew approximately 7.5%. According to data received from Smith Travel Research, comparable competitive hotels in our markets experienced a decrease in RevPAR of 6.7% for the third quarter of 2025 compared to the third quarter of fiscal 24, indicating that our hotels outperformed the competitive set by 5.2 percentage points. We believe our outperformance resulted primarily from strong sales results with our group customer segment, as well as a strong summer season at Grand Geneva Resort and Spa, and higher results from the recently renovated properties in our portfolio. When comparing our RevPAR results to comparable upper upscale hotels throughout the U.S., the upper upscale segment experienced a decrease in RevPAR of 1.3% during our third quarter compared to the third quarter of fiscal 24, indicating that our hotels performed generally in line with the industry despite the growth headwind from the prior year RNC impact, and they outperformed the industry by nearly 9 percentage points when adjusting for the estimated impact of the RNC on our RevPAR growth. With the strong growth in group business and events, our banquet and catering operations continue to grow, with food and beverage revenues up 8.3% in the third quarter of fiscal 25 compared to the prior year, which includes the impact of the headwind from prior year RNC-related banquet and catering events. Finally, hotels adjusted EBITDA was essentially flat in the third quarter of fiscal 2025 compared to the prior year quarter, which we believe was a significant achievement given the changes in our revenue mix, with a decrease in high-rate, high-margin rooms revenue in the prior year due to the RNC, and the increase in comparatively lower-margin food and beverage revenue. Shifting to cash flow in the balance sheet, our cash flow from operations was $39.1 million in the third quarter of fiscal 2025, compared to cash flow from operations of $30.5 million in the prior year quarter, with the increase in cash flow primarily due to differences in the timing of various working capital payments. Total capital expenditures during the third quarter of fiscal 2025 were $20.9 million, compared to $18.5 million in the third quarter of fiscal 2024. A large portion of our capital expenditures during the third quarter were invested in the Hilton Milwaukee renovation, with the balance going to maintenance projects in both businesses. Our capital investments and renovations projects have progressed as planned, and we now expect capital expenditures for fiscal 2025 of $75 to $85 million. The timing of several projects will impact our final capital expenditure number for the year. Looking ahead, as we get past the heavy part of the reinvestment cycle that we are in this year with our current hotel portfolio, we see a meaningful step down in capital expenditures in 2026. Our preliminary expectation is for approximately $50 to $55 million of capital expenditures in 2026, with this range subject to adjustment for the final timing of payments for our 2025 projects. We ended the third quarter with approximately $7 million in cash and over $214 million in total liquidity, with a debt-to-capitalization ratio of 26% and net leverage of 1.7 times. Finally, in today's earnings release, we announced that during the third quarter, we repurchased approximately 600,000 shares of our common stock for $9.1 million in cash. This brings our share repurchases this year to just over 1 million shares, or approximately 3.2% of our outstanding shares at the beginning of the year. Our cumulative buybacks since resuming share repurchases in the third quarter of 2024 are now over 1.7 million shares, or approximately 5.3% of our outstanding share count when we began, returning nearly $26 million in capital to shareholders. Our strong balance sheet and confidence in our businesses gives us the ability to continue pursuing growth investments while returning capital to shareholders through our quarterly dividend and opportunistic share repurchases. We will continue to allocate capital with a balanced approach that supports our strategic priorities while pursuing investments that provide the most attractive returns to shareholders. Greg will further discuss our capital allocation approach and today's announcement of an increase in our share repurchase authorization. And with that, I will now turn the call over to Greg.
Thanks, Chad. Good morning, everyone. When we were together last quarter, we shared that our summer was off to a solid start in both of our businesses. In theaters, a more diverse film slate was bringing out audiences for a series of solid performances. In hotels, we were gaining momentum as we entered the third quarter and were well positioned with several newly remodeled properties in our portfolio. As the rest of the third quarter played out, we saw some divergence between the results of our two divisions. In theaters, we saw a late summer movie season that included several films that performed well and met our own expectations, but it lacked a runaway hit blockbuster film that we've had the last couple of years, and the film mix was challenging for our markets. In hotels, our team executed exceptionally well, capitalizing on both group and leisure demand, and delivered a quarter that outperformed our competitors in the nation, overcoming a very difficult comparison to our record third quarter results last year. As I will discuss today, while the overall result was a mixed quarter compared to our own expectations, there were many positives that we think will benefit us in the long term. I'll start with our theater division. In a quarter where there has been much industry discussion about a national box office that was down nearly 12%, I'd like to step back for a moment with some perspective and start with a few things that we thought were positive. First of all, we had good product supply with 32 wide releases in the third quarter this year compared to 29 last year. The film slate was less concentrated, and many of the smaller mid-sized pictures actually performed better on average than they performed last year. When you get past the top 6 movies in the quarter, the average box office gross per film for the next 14 films in the top 20 was up over 11%. We believe this illustrates that there is an important role for small and mid-sized films in theatrical. And contrary to some of the narrative in the trade press, audiences want to come out to see these movies in theaters. Second, there were several films that outperformed expectations. James Gunn's Superman opened to $125 million domestically, achieving over $350 million in box office during its domestic run and grossing over $600 million globally. More importantly, the success of this DC franchise film sets up a promising outlook for future sequels with more DC adventures on the horizon. Zach Cregger's horror hit Weapons crossed $100 million in domestic box office in just 2 weeks, on its way to over $150 million for the run. Conjuring: Last Rites smashed box office records with both the highest domestic and global opening for a horror film, going on to become the highest grossing film in the Conjuring series. Demon Slayer: Infinity Castle broke the anime record with a $70 million domestic opening and has continued to play strong to become the highest grossing international movie ever in the U.S. with a domestic run now over $132 million. These were all great results for these films, and they illustrate the audience appeal for a wide range of content across genres. So where did the summer box office come up short compared to last year? We think it ultimately comes down to a couple of simple factors. First, we didn't have a breakout smash hit this year that was the must-see film of the summer as we've seen the last 2 years. The number one film in the third quarter last year was Deadpool and Wolverine, and in 2023 it was Barbie, with both films grossing approximately $630 million domestically in the quarter. As I discussed earlier, the number one film in the quarter this year, Superman, was a great success for many reasons, but at $350 million, its gross was approximately $280 million lower. We've been in this industry for a long time, and this dynamic with varying levels of box office hits from year to year isn't new. It's just the nature of our business. Second, in the third quarter, the summer box office was lighter on family films, a genre where we typically outperform. Last year, our top 5 films in the third quarter included Despicable Me 4 at number 2 and Inside Out 2 as the number 5 film, which was a second quarter release that carried over and held strong into the third quarter to contribute $183 million to the third quarter domestic box office. This year's third quarter did not have a family animated film in the top 5 and didn't benefit from carryover of family films released in Q2. Again, this isn't really a new phenomenon, but it did create a tough comparison to last year, particularly for our circuit, which historically has outperformed on family films. Chad discussed the factors we believe are impacting our box office growth relative to the nation. And while we underperformed the nation by just under 4 percentage points, this was primarily due to our strong outperformance in last year's third quarter, coupled with a film mix this year that didn't include many family films. I'm pleased to share that we continue to make progress on optimizing prices to capture a premium during peak periods and maintain the right balance of value-oriented options for more price-sensitive customers during lower demand periods. As expected, our admission per caps improved during the third quarter as we implemented blockbuster pricing on high-demand films and continued to adjust pricing for our everyday matinee program. We expect continued growth in our admission per caps for the next several quarters. We're looking forward to an exciting fall and holiday film slate with Wicked for Good, Zootopia 2, Five Nights at Freddy's 2, The SpongeBob Movie, Search for SquarePants, and Avatar, Fire and Ash, just to name a few. Advanced ticket sales of Wicked for Good have been strong and are currently trending over 3 times ahead of pre-sales for last year's Wicked. As we look ahead to next year, the 2026 film slate features major franchises including Spider-Man Brand New Day, the Super Mario Galaxy Movie, Moana Jumanji 3, 2 different movies, Toy Story 5, Mega Minions, The Mandalorian and Grogu, Dune, Messiah, and Avengers, Doomsday, just to name a few. There are many more great films coming, noted in today's earnings release. The 2026 film slate continues to fill in, and the early indication is that while there are a similar number of franchise films in 2026 compared to this year, the grossing potential of the 2026 franchises is greater based on their historical predecessor box office performances. The 2026 slate currently includes 4 films where the predecessor earned over $500 million at the domestic box office, compared to only 1 such film in 2025. Moving to our Hotel and Resorts division, you've seen the segment numbers, and Chad shared some additional detail on the performance metrics, including our outperformance to the competitive sets. We expected this quarter to be a challenging comparison to last year for the hotel division, given the significant impact the RNC had on our Milwaukee hotels in the third quarter last year. And I'm thrilled to share that our team met the challenge and delivered absolute growth to overcome the tough comp. The RNC was an extraordinary event for our largest market, and when we back out the RNC impact from our prior year results, our core business performed very well. In particular, 2 of our newly renovated properties, Grand Geneva Resort and Spa and the Pfister Hotel, benefited from our investments in renovations and great execution by our teams to deliver outstanding results this quarter. There were several notable items in the quarter that I'd like to highlight. Average daily rates during the quarter were generally strong, with rate growth at 4 of our 7 hotels when adjusted for the prior year RNC impact. We have been successful in achieving higher rates at our hotels with newly renovated room product, including the Pfister, Grand Geneva Resort and Spa, and Hilton Milwaukee. Occupancy remains strong, with occupancy growth at 6 of our 7 hotels. The combination of strong ADR and occupancy growth resulted in our properties once again outperforming the competitive sets, with impressive RevPAR growth of 7.5% when adjusted for the prior year impact of the RNC. Group business during the quarter was stable, and as we approach the end of the year, our group room revenue bookings for full year fiscal 2025, or group pace in the year for the year, are running slightly behind where we were at this time last year, which includes the RNC group business last year. Even more encouraging, group room pace for 2026 is running approximately 14% ahead of where we were at this time last year for the next year out, with banquet and catering revenues similarly running ahead of last year's pace. The current state of our hotel business remains stable and consistent with our view last quarter. While some markets have seen some more significant leisure softening, our own portfolio has generally performed well. Leisure transient demand remains soft in some markets around the country, but our hotel portfolio has not seen significant signs of softening or significant cancellations of group business. We believe our upper upscale positioning, drive-to market locations, and a broad segmentation lessening our exposure to any one type of customer will see less volatility if further economic softening occurs. There remains an increased level of economic uncertainty compared to where we were a year ago, and if we begin to see softness, we are prepared to react and adjust quickly. Our operations team is continuously focused on labor efficiency, and we've developed a strong track record of successfully managing through a changing demand environment. Finally, I'd like to close with our views on capital allocation and returning capital to shareholders. For the last couple of years, we've made significant reinvestments in our assets, and as Chad discussed, we expect to move past this heavy CapEx cycle next year as we shift back to a more typical maintenance and ROI CapEx mix. We're seeing great results from our renovated properties, and we believe these investments will continue to have attractive long-term returns. On the growth front, we continue to look for opportunities to deploy capital to grow both of our businesses with value-accretive investments. We have confidence in our businesses and a strong balance sheet that allows us to move quickly when we see good opportunities. And we have a history of executing when they arise. To the extent that we don't see attractive investments that are actionable, we expect to return excess capital to shareholders through share repurchases or dividends. As Chad described in greater detail, we've repurchased over 5% of our outstanding shares through opportunistic share repurchases since we began repurchasing shares in the third quarter of 2024. Between cash dividends and share repurchases, we have returned over $25 million, or approximately 80 cents per share, to shareholders in the last 4 quarters. This morning, we announced that our board of directors has approved a 4 million share increase in our current repurchase authorization, bringing our current share repurchase authorization to 4.7 million shares. In the absence of growth investments with attractive returns, we will continue to use this authorization to opportunistically repurchase shares and return capital to shareholders. And this new authorization will give us the flexibility to move quickly as opportunities arise. Throughout our company's history, we've taken a balanced approach of investing in long-term growth opportunities while returning capital to shareholders, and you should expect us to continue to do both going forward. It won't be all of one or the other. We continue to pursue growth opportunities in both of our businesses, and we're generally opportunistic, investing where we see value and attractive returns, whether it be in new deals or in buying back our stock, as we've done recently. Finally, tomorrow marks an important milestone in our history. On November 1st, 1935, my grandfather, Ben Marcus, founded what became the Marcus Corporation with the purchase of a single-screen movie theater in Ripon, Wisconsin. During the month of November, we will celebrate the company's 90th anniversary, and our theme for the year has been the spirit of entrepreneurship, one of the guiding principles that my grandfather and dad instilled in all of us, and our company's future will be built on that same entrepreneurial legacy. We are called on to push, change, and evolve because, as we know from our 90 years of history, the only constant has changed. I'm excited to celebrate our 90th anniversary with our associates, who, by the way, my grandfather taught us are our most important asset, as we both recognize our achievements and look ahead to a future that will continue the legacy of these great businesses for many years to come. Before we open up the call for questions, I want to conclude my remarks by saying thank you to all the hardworking associates of the Marcus Corporation. I don't want to ever take for granted what each and every one of them does to contribute to the success of both of our businesses. Thank you. With that, at this time, Chad and I would be happy to open the call up for any questions you may have.
Thank you. Please press star followed by the number 1 if you'd like to ask a question, and ensure your device is unmuted locally when it's your turn to speak. Our first question today comes from Eric Wold with Texas Capital. Please go ahead. Your line is open.
Thank you. Good morning, guys. A couple questions. You mentioned on the hotel side, you mentioned that you had rate growth in 4 of the 7 hotels in the quarter. I guess for the other 3, is that something that was more of a short-term issue? Is that something that's kind of been more than 1 quarter where you haven't had rate growth at those 3 hotels? Something that's, you think, more of a competitive issue in those markets? I don't want to lean on that too much, but I just want to see if it's more of something that's been short-term or something that's been more than a quarter. And then is that something you think that's more of a competitive issue or something that may require an investment as you look in the next couple of years?
Thanks, Eric. Yeah, I mean, at the 3 hotels where we didn't see ADR growth, I would say they're more market dynamics. 2 of them have been persistent market dynamics that are more generated by supply in the market. And in the 3rd, it really was just a little bit of softening very recently in demand. But I don't know at two of the three, I don't see significant CapEx investments. We have one of those three that we're going to be doing some small refreshes to, but nothing anywhere near what we've done at the three major properties over the last few years. I would describe it as a more normal course refresh that is embedded in our 50 to 55 million of CapEx that we expect for next year.
Got it. And on that 50 to 55 million, is that considered, kind of including refreshes, is that considered, I guess, more of a maintenance CapEx number kind of going forward? Anything that would be kind of unusual in that number?
It's not 100% maintenance. There is some ROI that we're doing in that, and we've done some of that this year in the theater business, and there'll be some of that again as we look forward in both of the businesses. There's always some of those types of activities, but it is primarily maintenance and ROI capital.
Got it. And then last question. I know you touched on this a little bit with the capital return comments. With the increased share purchases this year and the new buyback authorization, should M&A. I know obviously you'll have some increased free cash flow with the reduced CapEx next year, and presumably going forward. But should M&A opportunities come up on either the hotel or the exhibition side, can you talk a little bit about your comfort taking on leverage to the balance sheet, and kind of what's kind of your comfort level on kind of a leverage ratio, and then also should the equity get back to a more whatever in your mind be a more appropriate valuation, would you use equity for M&A in the future, or is debt in your view the more appropriate kind of a way to kind of go about that?
Yeah, on the first part of your question on M&A, I think if we have something that's actionable, we will move on it. We have been allocating a lot of capital to share repurchases lately, and at the current leverage at 1.7 times, we're very comfortable, and we actually have a target leverage that's a bit above that, closer to 2.25 to 2.5. So we have some capacity to do that. And if we found the right type of M&A opportunity, we have some flexibility and can flex up a bit and then bring ourselves back down to somewhere in that target level. But very comfortable with where we're operating right now, and there's actually some room to do a bit more and continue to invest.
As for whether we, the taking on more leverage and doing things, we have that balance sheet capacity, as Chad pointed out. Would we use equity? Yeah, I mean, look, we have a history. If you look, and this, Eric, if we go back when we think that the opportunity to return capital to shareholders through stock repurchases makes sense, we do that. When we believe the stock is at a price where we think it's appropriate to use it as capital, we do that as well. And so it will just depend on market conditions. We are not a company that just says, well, we programmatically buy stock no matter what the price is, or we're going to sell stock to grow just to raise equity. We will do it based on what we think the price is and whether it makes sense.
And just to be clear, at the current levels, obviously we're in the market, and we were repurchasing shares during the quarter, and so that's kind of the level that we're at right now. You wouldn't see us issue equity at the current share price to go do M&A.
Completely understand. Appreciate it. Thanks, guys.
Our next question comes from Patrick Scholl with Barrington Research. Your line's open.
Thank you. I'm just curious on concessions. Just with the current macro environment, have you seen any change in how consumers are, like just consumer uptake, or I guess hesitancy with regard to price increases and ability to offset inflationary pressures there?
Hi, Pat. No, we haven't really seen a lot to speak of over the summer in changes in consumer buying patterns. The hit rate and the basket sizes have been pretty consistent. We've moved through inflationary type price increases, nothing overly aggressive as we've seen in our per caps. And there's actually been more propensity for our customers to buy merchandise associated with concession purchases. That's been a nice part of the uplift, but nothing that we've seen that would tell you there's a change going on in the willingness to buy concessions.
Okay. And then maybe just a question on the M&A market. Just, kind of with the I guess, softening macro environment in hotels and maybe some stability in the film slate. I'm just kind of curious how you're seeing like the various macro factors kind of affecting the M&A market in those two segments.
It feels like there's some more trends. I mean, look, if you look at it from a macro level and you back up, the market is still very, very sluggish in terms of transaction volume. But if I have to say, how does it feel right this minute? It's starting to feel like there's some more stuff happening. I don't think we're seeing so much selling pressure from anyone feeling the pressure to sell from a performance standpoint yet. I think you get people who just own things too long, and that's their issue. The thing I think we bumped into, and by the way, if interest rates come down, that will help. Because again, I think one of the bigger challenges that we bump into is if you wrote a pro forma to buy an asset and you had an exit cap that's significantly below where cap rates are now, and you don't have to sell, you're gonna hold on as long as you can. And so since the economy has held up, we're not seeing people feeling pressure at forced sales. You're seeing people where now they're starting to say, well, okay, am I going to make the reinvestment in the next cycle? Because PIPs are coming up on people. Am I going to want to reload that? And that's probably where we're seeing some opportunity. It's more along that. We're not feeling that, as you might be alluding to, some economic pressure as the economy slows down.
Okay, thank you.
Thank you. Our next question comes from Drew Crum with B. Riley Securities. Please go ahead.
Okay, thanks. Hey guys, good morning. So I think you talked about expectations for admission per cap growth over the next few quarters. Does that incorporate or contemplate any further changes to your pricing strategy? And if so, what are those? And any early learnings from the pricing increases you took at the beginning of 3Q?
Hi, Drew. Yeah, it does not contemplate a lot of significant changes prospectively beyond what we did in the third quarter. It's more the annualization benefit and tailwind that we'll get from, frankly, flipping from a headwind on some of the discount programs that we've been comping for the last year to now moving to some strategic pricing moves that have increased pricing, and that becomes a tailwind. During the third quarter, we had blockbuster pricing on a number of films that our pricing approach on that evolved a bit throughout the quarter in terms of the length of period that we had blockbuster pricing on, and an everyday matinee evolved a bit during the quarter, but I think we've hit a level that makes sense. Pricing, as we talked about last quarter, continues to be an area where the industry has done various experimenting, and so we'll continue to watch what others are doing. But in what we did in the third quarter, it is having the effect that we expected it would.
Got it. Okay. And then you guys discussed the composition of the slate in 3Q having a negative impact on your theater admissions. Now, as you look at 4Q, how are you viewing mix? Is it a positive for your circuit, negative, or too tough to tell?
Yeah, I'll start first and let Greg add on his thoughts. I mean, I think it's a little bit tough to tell. It's easy to forget that we had a Moana film in the fourth quarter last year, and we don't have something quite like that. We do have a couple of family films here coming up in the quarter. And we have an Avatar, which we didn't have last year. So there's several puts and takes. It's frankly tough to tell on mix.
So It's so hard. It is really hard to tell.
Yeah.
We never know. Well, again, but glad we got Zootopia. Glad we got Wicked. Those should play good in our markets. SpongeBob, I'm a fan. So, but we'll have to see how it goes.
Okay. All right. Thanks, guys.
Wow, that was about as big of a non-answer as you can
Thank
get
you.
about
And just as a
Q4. We'll
reminder,
see how
please
it
press
goes.
star followed by the
Oh
number one
my
if you'd like
gosh.
to ask a question today.
They're worried like me.
We'll move to our next question from Mike Hickey with Benchmark. Please go ahead.
Hey, Greg, Chad, thanks for taking our questions. I guess first, Greg, obviously I heard your prepared comments on 26 for both your segments. Sounded pretty bullish, actually, encouraging. Just would love to get sort of your off-script thoughts, Greg, on the growth opportunity you see from theaters and hotels, and any catalysts or major drivers. Obviously, you listed a lot of films. That sounds encouraging. Maybe something that's very relevant to your demo. And on the hotel side, I don't know if the Mark, that seems like a really interesting project that you guys are doing, if that could be a catalyst, or any other initiatives that you think could move the needle for you guys across your two segments in 26. I got a couple follow-ups.
Sure. Look, on the theater side, me, Mike, I tend to hate to try to predict how things are going to go. I always go down to, let's just count the number of films and that'll give us a range. And then I don't know and then in some years it's going to be better, or some years in some periods it'll be not as good. I mean, I keep reminding myself, Memorial Day this year was the biggest Memorial Day in the history of the movie business. And then summer slowed down, you just don't know. But I thought it was a really interesting data point to look and say, well, look at the number of franchise films next year, pretty much like this year. I think maybe one less. But if you look back at the historical grossing of what the franchise films that are coming around this time, certainly more robust than we had in 25. So I'm not going to ignore that stat, and I'll go to bed feeling good about that. But it's hard, again, always hard to predict. On the hotel side, look, we've made a lot of investments that should continue to bear fruit for us, which is great. There's that old saying that old smells and new sells, and so that's very good for us, and we should see that. I don't want to overplay the Mark thing. The Mark was done opportunistically, frankly. We've been very disciplined about the amount of investment we wanted to put into the Milwaukee Hilton, and we had made the decision that we weren't going to renovate the entire property. We were going to actually close 176 keys, and we looked at it and said, but we weren't going to close them immediately, and we had demand for the rooms. And so while there's demand for the rooms, we're not going to actually make much of an investment in it. We're just going to separate it out from the Hilton system, basically, and we'll run as an independent. And it's a way to, if it's there, let's get some cash flow off of it while it's there, while we figure out where it's going. And if the city and the community decides they want to go in a certain direction, because it will involve all of them, that any further investment in the hotel, frankly, is going to require subsidy. And if that's going to happen, then we're all ears. If not, that will become a different use. But while it's waiting, let's warehouse it and get some cash flow from it.
Mike, I just want to add on one comment on the 26 slate in terms of film mix. The one thing that does stand out is when you look at family content next year and you look at the franchises, we have a Mario Brothers, we have a Toy Story, we have a Minions movie, we have Moana, we have a Jumanji. I think the family mix comparatively to 25 is very helpful for our circuit.
There we go, Dink. Next year's the year for families.
Then I guess, given that you guys seem optimistic on growth, how should we think about the bottom line here, EBITDA growth, potential operating leverage, and free cash flow conversion? I know that's come up a lot when you think about, I guess, catalyst to your valuation. I think free cash flow in 26 would probably stand out as the largest.
Yeah, no doubt. I mean, just by virtue of the CapEx coming down, our free cash flow is going to grow significantly next year. And then I think as the highest leverage is in the theater business, and so if you assume, the hotel business kind of continues steady as you go, as it has with a stable economy, if you believe the 26 slate will grow, our operating leverage in theaters is historically contributed around 50% to the bottom line in top line growth. So, we continue to focus on managing our cost structure and getting better at managing these buildings when you're in the troughs of the content supply. That's really critical to holding that type of contribution margin, because the peaks and valleys have been pronounced the last couple of years. But yeah, the EBITDA, the EBITDA should flow through with if the top line grows as you would expect for the slate.
Nice. Thanks, Chad. Last question. Obviously, recent news that Mark is retiring. Sad to hear that. 55 years. You never hear that sort of tenure with the company. So congrats to him. Just curious on the transition plan, and if this could also be a potential catalyst for maybe a change in strategy on how you manage your theater asset.
Well, we're in the middle of a search for the new leader. We're looking at internal and external candidates. We have both, and with a new leader, look, the idea is that we hopefully will see new ideas and new approaches. And yet, look, we're celebrating our 90th anniversary. I don't think that we're going to see we're going to wake up with a wholesale change as to how we approach the business. But I like the idea of new ideas and bringing out new approaches, and we're always trying to do new things to figure out what will work. And most of it doesn't, but every once in a while you find one and we'll run with it. I can't tell you, it's like the surprise movie. I never know what's going to hit, but there always is one.
Nice. Thanks, guys.
I think it's exciting.
Thanks, Mike.
Thank you. At this time, it appears there are no other questions, so I'd like to turn the call back to Mr. Paris for any additional or closing comments.
We'd like to thank everybody for joining us today, and we look forward to talking to you once again in late February when we release our fourth quarter results. Until then, thank you and have a good day.
This concludes today's call. You may disconnect your line at any time.
All right, a lot of good Q&A there, a lot of good things to think about. Marcus Corp with 31 million shares outstanding, trading at $14. I have a $24 price target on it over the next 12 months based on next year's box office and their hotel business, and that's about a 71% gain in the next 12 months, if I'm correct. I was just laughing in the chat. People always tell me, Tony, why do you talk about AMC? Why don't you talk about anything else? Just as an example, guys, I tweeted out my 71% price target. You guys that are regular viewers know we call out bangers all the time with relative safety. Bangers with relative safety. I tweeted out my price target on MCS an hour ago. Not one like, not one retweet. Why do I talk about AMC? Because nobody wants to learn how to make money the easy and slower way. They want to hear about 80% traded off exchange and the shorts have hidden 3 times the float in an off-books arrangement over in the dark pools. I mean, there are ways to make money in the movie industry, guys. Find profitable companies and invest in them when things are a little bit shaky, like right now. Marcus Corp, you're going to make money in it in the next year. AMC, maybe we'll make money on it. I'm looking for an opportunity, but I got some risk stuff that needs to get out of the way first. And why don't I talk about other tickers? I do all the time. all the time. We talk about speculative plays. We talk about many things. And a lot of the tickers I cover, like a GameStop or AMC, is simply for the fact that there are so many people putting out shit information on these companies. And some of y'all want a non-emotional, non-biased, just, hey, as an investor, how do I make money on this damn trade? That's the value I hope to provide. I am long MCS. After selling at $22 in November of 2024, I'm back in this trade. Let me know in the comments if you're watching now or in on replay. Anya asked if we could do one more poll. Who is watching right now? Do you have a position in MCS? I'm going to put the poll up and then we're going to wrap this up. Do you have any long... Do you have any long position in MCS? Yes or no? Play lobby music? No, don't play. Yeah, as far as other tickers, you know, I'm not trying to talk you guys into one ticker or out of another. I play multiple tickers in this segment according to my risk management rules. According to my risk management rules. So my rules might be different than yours. My analysis of all of these trades might be different than yours. That's fine. The market is made up of a whole bunch of people with different ideas. I'm never going to laugh at you, denigrate you, argue with you about your viewpoints. You can have whatever viewpoints you want. I will discuss my opinions and how I analyze these trades. And if you don't like honest discussion, if you don't like open debate, then there are Hopium channels you can go tune into. We're here to make money. We're here to protect capital and get a good community of people with eyeballs on trades like that, whatever they are. And if there's a speculative trade and I think the risk to reward is there or the chart is taken off, we're going to jump on that too. Any thoughts about ACHR? Is that Archer? Archer and Joby, I've done some coverage on them in the past. I like the technology. I worry about them being like a lot of the EV companies where you got a heavily capital intensive business not really generating any revenue yet. So that's the thing to spend a lot of time thinking about. When are they going to get revenue? Let's... If y'all have any questions about MCS, let me know. I will put out a summary video on IMAX and MCS over the weekend. And don't forget, next week we have Cinemark and AMC reporting their earnings. Archer still has no revenue. I mean, you got to understand, no revenue companies are the highest of speculative. You got two really speculative plays. Your no revenue companies, like you're signing up for dilution, right? You know that. And then you got money losing companies. You're probably also signing up for dilution if you hold them long enough until the point that they're generating revenue or generating positive returns. Now, people get excited about these stocks. I love the technology of Archer. But your timing has to be impeccable to avoid dilution and then jump in the play either before a momentum run up, a FOMO run up, or before they really move into some revenue generation. So no hate on ACHR. I want to see them succeed. I think you need to be really smart about timing. For me, it's only a trade, swing trade. And I will continue to follow it. I don't do frequent updates because what's there to talk about? Video updates. What is there to talk about? They don't have revenue. When I think the point is like, all right, this business is about to become viable. Let's go. I'll probably do another update. Ladies and gentlemen, thank you very much. I'm going to go make an early lunch for myself and the wife. She is off today. We're going to go see Begonia at some point today. We got AMC trading flat at 254. IMAX up almost 1%, 32.65. Cinemark up 1.5%, 26.55. Dolby up 1%, 66.37. And Marcus Corp, the little hotel and cinema chain, I call them little, what they say, they're the fourth largest in America, up 6% on a good quarter, positive earnings, a great balance sheet. They own 62% of their properties, including hotels. Share buybacks, another share buyback authorization for the next year. What is not to like? Why is nobody retweeting or liking my tweets? I guess some people just gluttons for punishment. GameStop up 0.13%. Thank you guys. We love you. Have a good rest of your day. And we will see you a little bit later. I don't know what we're doing yet for Halloween. The wife keeps on, do you want to go to this spooky musical show, or do you want to go to this haunted house, or should we stay here and hand out candy? We haven't decided yet. I don't know if I'll be home. I don't know if I'll be live. To be determined. But I will be around in Discord the rest of the day. And if y'all have any questions about MCS, feel free to leave a comment if you're watching on replay. Thank you. Have a good one.
A red candle down by the dip, gotta hold our ground. We've been waiting for so long, Hedges' rain will soon be gone. A green candle up, a red candle down by the dip, gotta hold our ground. Hedges' games are dead and gone, fuck the shorts, we're going long. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down, by the dip, gotta hold our ground. We've been waiting for so long, Hedges' rain will soon be gone. A green candle up, a red candle down, by the dip, gotta hold our ground. Hedges' games are dead and gone, fuck the shorts, we're going long. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down, by the dip, gotta hold our ground. We've been waiting for so long, Hedges' rain will soon be gone. A green candle up, a red candle down, by the dip, gotta hold our ground. Hedges' games are dead and gone, fuck the shorts, we're going long. If you doubt it, sit and stare. If you love it, buy a share. Green candle up and red candle down, by the dip, gotta hold our ground. Hedges' games are dead and gone, GameStop's rising, going strong. If you doubt it, sit and stare. If you love it, show you care. A green candle up, a red candle down, by the dip, gotta hold our ground. We've been waiting for so long, Hedges' rain will soon be gone. A green candle up, a red candle down, by the dip, gotta hold our ground. Hedges' games are dead and gone, fuck the shorts, we're going long. A green candle up, a red candle down, by the dip, gotta hold our ground. We've been waiting for so long, Hedges' rain will soon be gone. A green candle up, a red candle down, by the dip, gotta hold our ground. Hedges' games are dead and gone, fuck the shorts, we're going long. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down, by the dip, gotta hold our ground. We've been waiting for so long, Hedges' rain will soon be gone. A green candle up, a red candle down, by the dip, gotta hold our ground. Hedges' games are dead and gone, fuck the shorts, we're going long. If you doubt it, sit and stare.